Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times bestselling author and the Chief Global Strategist for West Shore Funds. He's the former General Counsel of Long-Term Capital Management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome. It's good to have you back after the summer break.
Hi, John. Thank you. It's great to be with you and with our audience.
And we also have with us Alex Stanzik, the Managing Director of Physical Gold Fund. Hello, Alex.
Hello, John.
So Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. So Jim, I sometimes see you as a kind of an anthropologist specializing in a small tribe with its own strange language and behaviors, the tribe you refer to as the global financial elites. Well, the elites are having a busy time of it right now. They've recently been huddling at one of their annual rituals, the Economic Symposium in Jackson Hole. And of course, plenty of them were in attendance at the G20 Summit of World Leaders in Hangzhou, China. As the cracks continue to grow in the global monetary system, could we take a closer look at what this powerful group is thinking and how their mindset today could impact our fortunes tomorrow? Let's start with Jackson Hole. In your newsletter, Jim, The Gold Speculator, you mentioned a startling paper delivered by economist Marvin Goodfriend. Could you tell us about that paper and why you find it significant?
Be happy to, John, and just by way of sort of introducing the topic, you're exactly right. I have said that, in reading these papers and academic papers, speeches, releases, etc., written by policymakers, but often academics, PhDs, etc., and obviously they use quite a bit of highly technical jargon. And I find a lot of that's by design. It's really meant to exclude the everyday reader. And as I say, sometimes I feel like I'm an anthropologist going into these elite circles, listening to what they're saying, coming back and putting it all in plain English. Sometimes it's just a matter of translation. Although it is the case that for people who are put off by either the math or the jargon, there's a lot less there than meets the eye. When you've been trained in it and actually go through it, you can find that so much of it is not that complicated. It can be put into plain English. So that's a lot of what I do, just kind of translating for everyday listeners. We've never dumb it down, but I see no harm in putting it in plain English, but somehow that escapes the people we're talking about. And when we say elites, they are elites because they're in powerful positions, and they, think about elites, they love to hang out with other elites, so they'll be in a place like Jackson Hole or the G20 Summit recently or some of these other venues. But it's not some deep, dark conspiracy. You don't have to put on a tinfoil hat or imagine black helicopters hovering over the horizon. I mean, we know who they are. I mean, it's Janet Yellen and Leo Brainerd and Stan Fischer and Mario Draghi and certainly the leaders of the G20 that we know who the heads of state are, Obama and Angela Merkel and President Xi of China, and a certain number of professors, maybe a little less known to the public. But this group is easily identifiable, but they, collectively run the world of money and international finance. And of course, if you run the world of money, you have enormous power in the political sphere and geopolitical sphere. So that's kind of what we track and how we do things. And, we were saying before the call that one of the things we love about these calls is that there's never a shortage of material. My biggest problem sometimes is getting me to shut up because I tend to talk too long or too much. But the point is we've never had a shortage of material to share with the listeners, and today is no exception. Although I would say today is a slight exception in the sense that we probably have too much material. We've had two major meetings just in recent days. One, of course, Jackson Hole for our listeners who might not be familiar, this is an annual event in Jackson Hole, Wyoming, beautiful spot in the Grand Teton Mountains, and it's hosted by the Federal Reserve Bank of Kansas City. Of course, there are 12 regional reserve banks in the Federal Reserve System, and they each have their specialties, but this is one put on by the Federal Reserve Bank of Kansas City, and all the major, central bank heads and other policymakers are there, and a certain number of select journalists and academics and a few others. And it's done like an academic symposium. So what that means is that the speakers write a paper, a very formal paper, with footnotes and references and charts and all that, and then they deliver the paper. Might not read it verbatim, but stand up and kind of present it, and the paper is available. And so we just gone through that. And of course, the whole world was waiting to hear Janet Yellen's speech. She is the chairman of the Federal Reserve, has a lot of influence, and her speech, amazingly, was the biggest nothing burger I've ever heard. I mean, I read it. And by the way, reporters, they do get these things in advance. They're what they call embargoes. So you might get it the night before, but you're not allowed to write about it until, exactly 10 a.m. Eastern time, whatever the time of delivery is. And so it gives you a chance as a reporter to write your story in advance. And, they race each other to get the headlines out. And then, of course, the way trading works today, so you release the text of the speech. It might take a human, I'm a slow reader, maybe it might take me 20 minutes, half hour, a little longer to read it for meaning, but they have, of course, these robots, artificial intelligence robots, that scan it in a nanosecond, and they're programmed to look for keywords. So does she say rate hike or data dependent or places to it, whatever, they kind of program these keywords. So they read these things in fractions of a second. Then the computers take over the trading, and the computers start trading on something. Now, bear in mind, there's no humans involved in any of this, right? One robot's reading the speech, another robot's doing the trading. And this is where our markets are. I hope listeners understand that the days of, calling a broker and waiting for an order to fill, you can still do that, but that you're at the mercy of all these machines. So it takes a slow reader like me a little while to digest it. And you want to, I actually read the footnotes. I actually try to put it in the context of other things. So I might be days before I'm really ready to talk about it. The good benefit I have is I'm an analyst, not a reporter, so I don't have to be in a hurry. I just have to, try to do a deep dive and get it right. So the theme of the conference was basically a self-examination. Do we need new tools? Are the tools we have working? So this is 8 years of close to zero rates, 7 years zero, and now going on the year at 25 basis points, 3 rounds of QE, a $4 trillion expansion of the balance sheet, all kinds of manipulation that goes by the name of forward guidance, and no growth to speak of. We've had really pathetic growth all along, about 2% for 8 years versus trend growth closer to 3.5%. It's a very big difference, by the way. The difference between 3.5 and 2 doesn't sound like a lot. It is. You compound that over 25, 30 years, or even part of a normal lifetime, the one society will be twice as rich as the other due to compounding. Growth is weak, and lately it's been getting even weaker. For the last 4 quarters, growth is just barely above 1%. So weak and getting weaker is the way to describe growth. So they're saying, well, are the tools good enough? Amazingly, Janet Yellen said yes. She said we have, we can cut rates. They can. They raised them 25 basis points, so I guess they can cut them. Wall Street is spending all the time navel-gazing about the next rate hike. Not only do I not see a rate hike as far as the eye can see, but I would put the odds of a rate cut probably slightly higher than a rate hike. Now, no one's talking about that, but that's because it looks like we're heading into a recession right now. So they can cut rates. They can, then you're back to zero interest rate policy. They can do more forward guidance. Forward guidance is just jawboning or words. So you say, well, not only do we cut rates to zero, but we're not going to raise them for a really, 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 really long time. That's just a way of, by the way, if those words sound ridiculous, they're no more ridiculous than the words that the Fed actually uses. They do things like extended period and we'll be very patient. They have all these. That's a whole other process for how they come up with these words. It's the guy who wrote them. I talked to him privately. Said the process is ridiculous. That was the word he used. But be that as it may, they have these code words, which is really just a way of saying to the market, don't worry. Not only are the rates slow, So she said that the toolkit of zero interest rates, rate cuts, QE, and forward guidance will be sufficient. She might actually be the only person in the world who believes that. If she believes it, well, let's give her credit. The fact is, and by the way, Larry Summers at Harvard has done a lot of good work on this. He said that when the U.S. economy is in a recession, it takes about 400 basis points of rate cuts to just get the economy out of a recession. Now, historically, what that has meant is that if rates were 7% and you went into a recession, you could cut them to 3%, 400 basis points from 7 down to 3, and that would help the economy get out of a recession. So that's what you need to do. Well, what exactly do you do when you're at 25 basis points? We call it zero, right? So if you go into a recession now, and it looks like we are, and you have to cut interest rates 400 basis points to get out of it, but you only have 25 basis points to play with, how are you going to cut rates? Well, the answer is you can't. Unless you go negative, that's a whole other discussion. I'll come to that in a minute. But Yellen seems to think that by cutting rates, forward guidance saying we won't raise them, and QE is back on the table. History of QE is interesting. QE1 was, I think a lot of critics, including myself, would give the Fed credit for saying, okay, that was an emergency liquidity response to a liquidity crisis, to a financial panic. So I'll cut the Fed a little slack on QE1. But QE2 and QE3 are completely experimental. There was no, when they went into QE2 in 2010 and QE3 in 2012, there was no liquidity crisis. There was no financial panic. This was just Bernanke's experimentation to see if he could create a wealth effect and get people to spend more. Their stocks went up. What happened was the stocks went up. People didn't spend more. We just got another asset bubble. But Yellen is saying with more QE, we can get out of a recession. Very little evidence for that. No reason to think that's true. The Fed, of course, thinks they can raise rates before the recession so that they can cut rates when you have a recession. It's way too late for that. I mean, if that were ever true, the time to start raising rates was probably 2000. I said at the time 2009, but even if you want to say 2010, 2011. But they missed their chance, and now we're getting close to recession with no capacity to cut rates. So that begs the issue of what about negative rates? Now, the experience in negative rates is pretty bad. I mean, it looks like they don't work, but just because it's a bad idea doesn't mean the Fed won't try it. And that's where the Jackson Hole conference actually was interesting, because for the listeners who are interested, if you go to the Federal Reserve Bank of Kansas City website and look up the Jackson Hole Symposium, you'll see that there were 7 or 8 papers delivered, not just Janet Yellen. Yellen was the only one that anyone paid attention to. But the one I found most interesting, because geek that I am, I actually read all these, was one by a professor named Marvin Goodfriend. Now, he is an academic, so just to be fair, he's not on the Board of Governors, he's not a policymaker, he's an academic, and academics are supposed to come up with wacky ideas. But in my experience, you don't get invited to something like this unless your ideas are being taken seriously as possible policy. So if this appeared from some university in some financial journal, I might say, okay, fine, you want to think out of the box, that's fine. But when you're standing up at the podium at Jackson Hole, among very few invitees, by the history of Jackson Hole is that very important things happen there, which maybe are only revealed after the fact. Best example was August 2010, when they leaked the details on QE2. Now, QE2 did not formally begin until November 2010. That's when the Fed announced it and actually started doing the long-term asset purchases. But they kind of leaked it in August of 2010, and if you go back and look at the market action, the rally was in September. The stock market rally was in September, October. So important things do happen at Jackson Hole. So this Professor Goodfriend gives this paper and gave this presentation, and I think I'm pretty good at coming up with out-of-the-box ideas. This was the craziest idea I've ever seen, but I have to take it seriously. So now I want to pivot a little bit. I'll come back to Jackson Hole, but I want to pivot a little bit to the cash, because, again, I think a lot of listeners are familiar with this. The war on cash is you have to get rid of cash if you're going to have negative interest rates, right? Because what's a negative interest rate? You put your money in the bank, and instead of paying you interest, they take your money away. So you put $100,000 in the bank, and you go away, and you come back a year later, and there's $99,000 left. They took out 1% negative. If the negative rate's 1%, they would take away 1% of $100,000. So you'd have $99,000 left. So instead of paying you interest, so you have 101 like you did in the good old days, or 104 in the really good old days, you come back and it's only 99,000. So people say, well, okay, I can get around that. I'll just heck with the bank. I'll just go to the bank, take my money out, put it in a safe place, and a year later I'll still have $100,000. I won't make anything, but at least they won't take away the negative interest rate. And people will do that, and they did it during the Great Depression for other reasons that they were worried that the banks were actually going to fail. But people put cash in, coffee cans and shoeboxes and bury it in the backyards or under their mattresses or whatever. That's what people do. So if you're going to have negative interest rates, you're going to have to get rid of cash. So that gives you the war on cash. Now, the war on cash has three vectors. The first is that the banks don't want to give you the cash. I mean, I've said this before. Try going down to your bank and getting $20,000 in cash or $10,000 in cash. First of all, you might not be able to get it. They might say, come back in a few days because we don't have that much cash on hand. Even if they do, for $10,000, they will file a report with the Treasury called a currency transaction report. And I don't advise this, but for people who think they're being cute and they say, well, get $9,000 and I'll come back tomorrow and get another $9,000, forget it. You'll end up like Denny Hastert. That's called structuring. They'll file a suspicious activity report, probably put you under investigation because it looks like you're structuring around 10,000. Just to be clear, don't do it. I don't advise it, but that's what will happen to you. You'll be investigated if you do that. And even for modest amounts, $3,000, one of my Treasury official friends said $3,000 is the new 10, called a suspicious activity report. And you will be treated like a drug dealer. You can be a law-abiding citizen and live in a town for 20 years. The teller, the person behind the counter, has no interest in helping you. They've been to 28 compliance seminars about how they'll get fired if they don't file the money laundering report. So they'll treat you like a drug dealer, a tax evader, or a terrorist and put your name in the file next to Al-Qaeda, even though you're just trying to hang on to your wealth by avoiding negative interest rates. That's the first vector. Second vector, this is more recent and more interesting, is merchants don't want your cash. More and more vendors are saying, we don't take cash. So you can go up to the counter, but you better get your debit card or your credit card or your iPhone or Apple Pay or something, or gift card, whatever, but they're not going to take your cash. So even if you can get it, which is hard, you may not be able to spend it. And the third vector, and here our friend Ken Rogoff, professor at Harvard, is the thought leader on this, although others have said the same, is just to get rid of the $100 bill. And so Ken Rogoff has a new book out on the subject. It's not quite a bestseller, but certainly selling very well, on the elimination of cash. So you can just Google Rogoff, R-O-G-O-F-F, on Amazon, and you'll see his new book, which is basically a manifesto to get rid of cash. So you might be down to $20 bills, and then you say, what can you do with a $20 bill? Well, maybe you can get a venti latte with an espresso shot at Starbucks, but then Starbucks doesn't even want your cash either. So in every respect, they're attacking cash. So you might just be victimized by having to be in the digital. By the way, one way to really get out of the system, which I recommend, is to buy physical gold. If you have physical gold, you're not going to have negative interest rates. You're not going to be abused suspiciously. It's a perfectly legitimate investment. It's a way to get out of this, I call it the digital slaughterhouse, where we're trying to round up all the digital savings into a small number of banks and slaughter you with negative interest rates. But anyway, getting back to Professor Goodfriend at Jackson Hole, he came up with another idea, so all the ones I just mentioned weren't enough, which is to come up with basically an exchange rate between cash in your pocket and cash in the bank. Now, this gets into the definition of money. A lot of people think bank deposits are money. So you get money in the bank, right? That's what we say. Or a money market fund is money, and the Fed says, they tell you they're money, and they want you to believe that. A bank deposit is not money. It's an unsecured liability of a bank, which could go insolvent, and then you get into insurance, but the insurance fund could go insolvent. So I'm not saying pull all your money out of the bank. I'm not saying that they're going to go insolvent tomorrow. I'm just saying that's not really money as far as I'm concerned. And then you have the famous money market funds. And of course, the SEC just changed the rules so the money market funds can suspend redemptions and don't have to give you back a dollar on a dollar. Let's go breaking the buck. So the New World money market funds they can be like a hedge fund and not give you your money back at all, or even if they do, they don't have to give you a dollar for every dollar you put in, which is, that has been true since the 70s, 1970s, but it's not true anymore. So that's money in the bank. But the Fed calls it money. I don't think of it as money, but the Fed does. So let's call it money for a minute. Well, if you have $100 in your pocket and you go up to the bank and you deposit it, the bank gives you credit for $100. You look at your statement, there's $100 more in your bank account. So basically, the cash in your pocket has par value relative to the balance on your bank account. You can put $100 of cash at the counter, with deposit slip, they credit your account for $100. What this professor said is no. We're going to treat that like a cross rate, like an exchange rate. So, so if you're going to Europe and you buy euros, you can buy euros, but you don't know what the exchange rate is going to be tomorrow or the next day. And what we do know is it fluctuates. And I get questions all the time. People are going on vacation and they're like, "Gee, should I buy my euros now or should I wait till I get there?" Depending on whether you think the euro is going up or going down. What he said, what the professor said, is that cash in your pocket and cash in the bank can have an exchange rate, and they're not exchangeable at par, and the Fed can set the exchange rate. The Fed is under no obligation to maintain parity. So what that means is in this future world that he's envisioning, you could take $100, give it to the teller with a deposit slip, and the deposit slip, the bank would credit your account with $98. So your $100 in cash would be converted to $98 of deposit credits, or vice versa. So let's say you had $100 in the bank, and you went up and said to the teller, "I'd like to withdraw my $100." So you went to an ATM and said, "I'd like to withdraw $100." The machine would give you $98. In other words, there would be an exchange rate between cash money and bank money, even though people think of them both as money, and that could fluctuate. And that is a way of imposing negative interest rates on cash, right? We already said if your money's in the digital system, they can impose a negative interest rate just by taking it away. And the answer is, well, I can go to cash and avoid the negative interest rate. And I just explained at length why that's really difficult. But let's say you did. Let's say you whatever. You say, "I don't care if they report in the Treasury. I'm an honest citizen. I want $50,000 in cash, please, and I'm going to put it in a safe place." Well, you might only get like $47,250 for your $50,000. It's not worth 100 cents on the dollar. So now the system is so corrupt and so extensive that they've even figured out a way to impose negative interest rates on cash in your pocket, because you can't take it in and out of the bank without suffering an exchange rate, which obviously would be adverse to cash. So they've even figured out a way to put negative interest rates on cash. I read this and I thought, well, from a professor's point of view, nice going, that's pretty creative. I've never heard of that before. But from a saver's point of view, I said, this is appalling. It's amazing the lengths to which policymakers and politicians and now academics will go to steal your money. And again, as I said, it's easy to dismiss this as the musings of some academic, but when you're at the podium at Jackson Hole and Janet Yellen, Sam Fisher, and William Dudley are in the front row, this is how things work. This is how they do it. They feed it out as an academic paper, then next thing you know, it's on some policy agenda. Some in-house economists writing a paper, and next thing you know, they're taking a vote. Next thing you know, it's real. And I saw this over the last 5 years with SDRs. SDRs are all news. People are talking about SDRs, and some people will say, "Hey, Jim, you had a whole section on this in your book, Currency Wars, in 2011. How did you know in 2011 that the world was moving to SDRs?" And the answer is because they told me. I went to the IMF website and found the papers. Now, do people do that? Normal people do that? No. If you found the paper, could you necessarily understand it without technical training? Probably not. It doesn't mean people aren't smart. I think everyday Americans are, I always say when it comes to your own money, everybody has a PhD. But you do have to have some technical training to understand this. And so the whole SGR blueprint was laid out in 2010, 2011. All you had to do was read it. So all I'm saying is don't dismiss this as something that will never happen. The blueprint was laid out at Jackson Hole, how they're going to steal your money one way or the other. And if you see it coming in 2 or 3 years, I'm telling you now that this is coming, and it actually happens 2 or 3 years from now, no one should be surprised because you can see this coming. So John, there actually was big news coming out of Jackson. It wasn't Janet Yellen, other than the news that she doesn't know what she's doing, which has been clear for a long time, but that was apparent from her speech. Other than the news that the Fed is completely unprepared for a recession, we can also see that. But there was this other paper where they can actually impose negative interest rates on cash, physical cash, just by having an adverse exchange rate to your money in the bank. So kind of watch that space. Now the other, I think that wraps up on Jackson Hole, John. And we want to talk about G20 a little bit. There's some good news there, and I'll flip it back to you.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.